Hello and welcome to the session on IAS 1 presentation of financial statement. My name is Nidhish Singh. I'm Vice President in JP Morgan and member of ACCA, CISI, Institute of Directors, and also a PhD researcher in area of finance and economics. I'm founder of FinCEP Institute, and today I'm going to run you through IAS 1. So before we do that, please subscribe to the channel, and you'll be getting the regular updates on accounting standards, various qualification, how to study various other papers, business, economics, other stock market topics, and career advisory, etc. So please subscribe and share with your friends and colleagues so that everyone can benefit. So back to the topic of IAS 1. So there are certain fundamentals to follow under IAS 1 for the preparation of the financial statement, and they are as follows. The first one is fair presentation and compliance to IFRS. So this reminds us to comply with all the other accounting standards and present the numbers as fairly and accurately as possible. That means asset, liability, expense, and income, they should be fairly and to the best knowledge of the preparer should be prepared. So it should not be hiding any information. It should not be overstating or understating any number. So it should reflect the economic reality. That is the meaning of fair presentation. Going concern is the next item that we need to follow and keep in mind. So what is going concern? That means in the near future, the company is not seeing any threat. There is no foreseen threat on its survival. That means when the financial statement is prepared, it is prepared assuming that it is going to continue for the near future or at least 1 year before the next financial statement is prepared. Because if it is going to terminate earlier or in near future, then the value of asset and liability presented in the financial statement can differ. And that's why the financial statements are prepared on the going concern basis. That means there is no near future threat on the survival of the entity, company, or the organization. Third concept, which is important, is accrual basis of accounting, which means the revenue and the expenses, etc., should be recorded and booked in the P&L or the balance sheet, etc., in the month they occur, not when the cash is transferred. Which means if I missed a payment for rent or any other thing, I need to book a liability. I need to accrue the liability. Same with the companies. If the company could not pay the auditor fee, they need to, in the month of say March or April, they need to book an entry which reflects that outstanding amount. That is actual accounting. Presentation consistency. The number should be displayed or calculated in a consistent manner, not just based on the thought or opinion of preparer. Like if we choose to follow operating lease method for the lease liability, we need to continue the same this year. If we change those policy, that has to be disclosed appropriately, but the consistency should be maintained. Offsetting means netting off asset and liability, which IFRS generally does not permit. So if the asset and liabilities need to be offset or netted off, there has to be certain agreement with the counterparty before we do that, and it is done on an exceptional basis. Then comparative information, which means reflecting the numbers of last year. So if I'm preparing the financial statement for 2021, I also need to disclose the numbers of prior year, 2020, provided, of course, the company exists in the last year, because that will help the user and the investor to compare and understand how the company is doing. So that is the reason of providing comparative information. Now, let's talk about the 4 primary statement and the disclosure notes, which is also mentioned in IAS 1, and what should be discussed in those primary statement. So before we go to that, let me just share the screen so that I can provide you a more visual way to reflect what we need to do in IAS 1 for primary statements, which is balance sheet, P&L, cash flow, and statement of changes. So let me share my screen. So As I said earlier, we have 4 primary statements. And starting with the statement of financial position, the balance sheet, statement of financial position. What we show there? Current assets and current liabilities. What will go in current assets? Some examples. That will be all the cash, inventory, land or long-term assets, property, plant and equipments, etc., and any asset held for the long term. Or sell. Next, similarly, opposite to this, any overdraft, liabilities, or payment due. So entity in this case does not have the right at the end of the reporting period to defer the settlement of liability for at least 12 months. So when we talk about the long-term liability of the entity, we mean that it cannot be basically when we talk about the current liability, we cannot defer it for beyond 12 months period. So that means an overdraft with the bank, or my vendor who are chasing for the payment and I missed that, so I cannot defer it for a longer time. So that will go into the current liability, right? And that's why here comes the CL, current liability. Next, let's talk about what would come under P&L, also known as comprehensive income, statement of comprehensive income. So entity has to recognize the various income, expenses, and various other kind of ad hoc expense. Everything will come under the comprehensive income. It's the big chapter itself. There are separate financial statements to deal with that. But just a high-level view, all the income, revenue, expenses, or discontinued operations, and any revenue from that discontinued operation, and any cash from there, those items will come under the comprehensive income. Next comes next we need to talk about the statement of changes in equity. So statement of change, often people we call it statement of changes as well. So here we talk about some very specific items, which is total comprehensive income for the period, and that is like pension asset and liability. So when we account for the pension asset and liability, we need to have certain contribution on regular basis, because the employees, when they retire, the organization will have to pay for their provident fund. So there has to be a pool maintained, and because of that liability, organizations often has certain expenses in every duration and some liabilities. So we need to reflect those changes, those delta from period to period in statement of changes, right? So that will come there. Next, all the new capital transactions plus all the different unrealized movement in the asset or the liability of the firm. So those will be recorded here. So amount of transactions with owners in their capacity as the shareholder, that need to be accounted here. That's what we call capital. And for each component in equity, there has to be a reconciliation between opening and closing accounts. So if I say that, okay, the company has 2 million of new capital this year, I need to show what was the opening capital, what is the closing capital, and how much new capital has been invested. So that kind of reconciliation is required for statement of comprehensive income. And then finally comes a very important statement called cash flow. So cash flow statement. It is prepared in two ways, direct and indirect method. IFRS prefer indirect method, though it permits even direct method too. Here we need to mention three key sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So these are the three types of cash flow that we need to reflect in the cash flow statement. Typically, operating activities is relating to trading, how much cash inflow and outflow has happened because of the normal business activity, that is a trading activity. So that will go under cash flow from operating activities. Next comes the investing activity. That means if a company like Infosys or Tata, they are buying some new land or the building, basically, that will become typically an investment. And thirdly, the cash flow from financing. That means any transaction with the shareholders or any payment to for their dividend or any such income from the investment in other companies or the dividend. So that will be considered the cash flow from financing, because it is purely a finance. It is a long-term capital that we are talking about. So that will go under cash flow from financing. That's how we prepare the statement of cash flow. So that really is for today's session on IAS 1. It is a big standard, and we need to go into further details in order to fully comprehend all the aspect of this. But for a summary session, that is important for you to know what are the key aspect of IAS 1, how we prepare the financial statement, what are the key elements. And in case you have any question or query, you can leave that in the comment section under the video. And you can also leave any query on connect@finsapien.com. Thank you so much. Happy learning, and we'll see you again.